On the program today, Zimbabwe records its highest wheat harvest this agricultural production year. And Thailand plans to support rice development in Ghana. Plus, Ethiopian Airlines to resume daily flights to Tigray. Hello and welcome to Business Incorporated. I'm Will Ibong. First things first, let's check in on the market, starting with Africa, where sentiments were mostly positive for major equities we track on the continent. Looking at the NGX, Nigeria's NGX was up 0.04% at intraday, while South Africa's JSE was really up 0.88% at intraday. Now, looking at other markets in Egypt, we saw them up 0.39%, while Kenya closed Friday's session on the flattish side, but still in positive territory. Now we move to the Middle East, where sentiments is still mostly positive at intraday. Say that investors are coming out of the Yuletide season, but Abu Dhabi is up 0.04%. Dubai, however, is down 0.39%, while Saudi gained more than 0.5%, 0.66% up at intraday, while the Qatari index is Saudi's index was up 0.29%. Now we move over to the EU, where rising prices are taking a bite out of organic food sales in Europe. A new year-end report from German farmers records a drop in sales across the category in 2022, the first of such drop year on year since it began recording organic sales. Now, Stephen Beersley joins me from Berlin. So, Stephen, so are shoppers just looking for cheaper alternatives to organic foods?
That definitely seems to be the case. Organic products already have a premium of anywhere from 25% and up over regular groceries here in Germany. Oftentimes, they're half again as expensive as something that you would find in a conventional grocery store. Food prices in general across Germany, whether they were organic or not, were up in November by 20% from a year earlier. So that gives you an idea already of just the baseline inflation that we're seeing. And then when you add that premium for organic on top of it, you can see why that is difficult for some shoppers. Now, according to this report, turnover fell in 2022 4.1% from the prior year to 15 billion euros. So that still is a pretty good turnover collectively, but that can be very hard for some specialty stores in particular that really depend on organic products. You know, the market share of organic here in Germany has been consistently growing throughout the years. It's reached 7%, close to 7%, I should say, in 2021. And really, it depends so much on price. There are hardcore shoppers who will always buy organic foods. They can afford it. But then to reach that mainstream, to make that mainstream appeal, it really depends on price. And so during a time when prices were good, it was easier to reach more of the mainstream. And I imagine that if prices continue to stay high, we're going to see that market share fall somewhat.
So does this mean that the Germans' organic foods sector is in trouble?
Well, there are many different selling points for organic foods here in Germany. As I mentioned, it's the specialty shops, those that focus exclusively on organic foods, or even specialty subsets of organic foods, which you see oftentimes here in Germany. Those are the ones that are going to be in the most danger. We do know that revenues are falling in the double digits for many of these organic supermarkets, and for the smaller ones in particular, it can be in the rather high double digits. So we've already seen that some regional chains have become insolvent, and we'll have to keep an eye on how some of the larger chains are going to handle that. Perhaps in the best position are the larger conventional supermarkets, which have expanded their organic lines over the years. But then, of course, they have those regular products on top of that to really support whatever dynamic they're seeing within their organic products. Interesting to note here is that past studies have shown really that when it comes to organic foods, they're very elastic in terms of demand. That is that once price starts to rise, many shoppers will drop those products. However, what we see here in Germany and perhaps some other nations is that there are certain products, organic products, that are less elastic. That is, that many people are willing to actually consistently pay more for organic milk, for organic produce, eggs, butter, things like that, that may not extend to meats, for example, which tend to have a higher markup. But we do see that in some areas, they may continue to pay and to buy higher prices just because that kind of organic mindset is established for that product.
So what are we expecting from the markets today?
It looks like today's going to be a rather muted day for European markets. Most indexes up slightly. The DAX, for example, up 0.1% at the start of trading. The FTSE 100 up 0.8%. It's playing a little bit of catch up as the London markets reopen for the first time since the holidays. Really, one of the two stories driving markets today, a reconsideration of what's going on in China with the reopening there. There's a lot of excitement yesterday. Now Asian markets were actually down a little bit on fears that the reopening could further contribute to inflation. And then also the Bank of Japan is going to be releasing its notes, its minutes from its last meeting. That was that meeting that surprised everyone when regulators announced that they would consider more rate hikes in the future, basically enabling further rate hikes at a faster pace. That caused a lot of disruption for the markets at the time. So that'll be something that investors are taking a look at, exactly the logic and the thinking behind that. But otherwise, it looks to still be a quiet period right now as we're between these two holidays. So it's unlikely that we'll see any major swings in either direction.
Thanks, Stephen, for the updates. And now for updates from the UK, we have Juliana right there in London. Hello, Juliana. Good to have you on the program. We see that Border Force staff are commencing the second in a series of strike at UK airports until the New Year's Eve. Is there any change or any in the government stance with regards to a deal to end this standstill we're seeing?
Good afternoon, Will. No news from the Prime Minister or any senior cabinet minister besides Robert Jenrick, who is a senior minister within the Transport Cabinet. He has asked passengers to expect significant delays and flight cancellations at a time when we know that millions of people are trying to get to and back from the UK so they can spend the new year with their loved ones. And this is because of the border strike. This is the second series of strikes, as you said, which are going to last up until the weekend. The Public and Commercial Services Union, which represents about 1,000 members working in British airports, are taking up industrial action because, similar to what we've seen across other sectors, they're not happy with pay, their job or working conditions. And this is going to be a high-risk strategy for the Prime Minister. He decided to go into recess, not negotiating with union bosses, saying that he puts inflation at a much higher priority than he does for pushing up wages. Because, of course, if he does pump billions of pounds into public sector wages, there is more money in people's back pockets, which means people spend more, inflation may go up. But according to recent polls, the vast majority of people in this country are supporting workers. I think the fact that inflation is at a 41-year high, most people in this country are struggling at the moment. They just don't have the union backing or the courage to go on these industrial actions. So I think he has lost the support of the public. But what happens now? Because, of course, this winter of discontent is something that we've not seen in this country since the late 1970s. People are very angry. Not only do we have the border strike today, we also have the third round of rail strikes taking place. They will last into the new year. We're expecting teachers to strike, driving instructors to strike, perhaps more strikes from NHS workers in January. When is Rishi Sunak going to sit down with these union buses? I think one of the things that's worrying commuters up and down this country, as well as union bosses, is the fact that the Prime Minister is mulling fast-tracking some new legislation, which would mean it would be much more difficult for those who work in essential services to strike. We first saw this from one of his predecessors, David Cameron, in 2016. I believe you had to have a 50% turnout threshold for unions to be able to start a ballot. But yes, it is incredibly difficult. So any of our viewers who are travelling over the next couple of days, please do check with airlines before you leave for the airport, because there are going to be significant delays, particularly across Gatwick and Heathrow terminals.
Juliana, this really requires what you say high-level strategy here to be able to balance this and looking at inflation on one hand and looking at wage hike on the other hand. How do you balance it? How do you reach a compromise that will be beneficial for all? Juliana, I would just want to know how markets are reacting to all of this right now.
Well, the markets are in pretty good shape, as we heard from Germany. This is the first day that the London Blue Chip Index is open after the Christmas holiday. There will be a further break, of course, because we've got New Year's on the weekend. It does appear as if mining stocks and insurance stocks are what's lifting the FTSE. Also, there's a slight bit of cheer because we know that the zero COVID policy in China is all and well but over. So the FTSE All-Share at intraday is up 0.74%. The FTSE 100, that's up by 0.79%. In the FTSE 250, the domestic market, that's up by nearly over 0.5%. In the currencies market, the British pound is trading up against the US dollar by 0.23%. £1 will buy you $1.20 at the moment. The pound is also trading up against the euro by 0.27%. And at intraday, the pound is trading up against the Japanese yen by 0.60%. Well,
thanks so much, Juliana, for the updates. And we'll keep track of what's happening and hope UK citizens and those traveling there have some breather from these strikes. Thanks so much, Juliana.
thank you.
Now, moving on to other matters, Asia-Pacific markets traded mixed after Wall Street's losses overnight as investors weighed headwinds from the economy in 2023. Hong Kong's Hang Seng Index added 1.56%, leading gains in the region and bucking the wider trend as Chief Executive John Lee announced further easing of COVID measures in the city. In mainland China, the Shanghai Composite closed 0.26% lower at 3,087 points. In South Korea, the Kospi fell 2.24%. Australia's ASX 200 shed 0.3% after giving up earlier gains. Now in Japan, the Nikkei 225 closed down 0.41% at 26,340 points. Now over to US, where stock futures climbed slightly in early morning trade today as traders look to the end of a losing year and prepare for 2023. Futures tied to the Dow Jones Industrial Average added 56 points. S&P 500 and NASDAQ 100 futures were up 0.13% and 0.02% each. Tuesday kicked off the start of a holiday-shortened trading week. Now the Dow Jones rose 37.63 points to close at 33,241. The S&P 500 fell 0.4%. The Nasdaq Composite, however, shed nearly 1.4%, and this was driven by an 11% drop in Tesla stock after the Wall Street Journal reported that the electric vehicle maker would make a week-long production pause at a Shanghai facility. Tuesday marked the 7th straight day of losses for the stock, and it comes at the end of a tumultuous year for the electric vehicle maker as owner Elon Musk executed a chaotic purchase of Twitter. Tesla's shares value is down 69% this year. Now, oil prices climbed early on Wednesday as markets were optimistic about fuel demand recovery as China continues to ease its COVID restrictions. Brent futures for February delivery rose 31 cents to $84.64 a barrel, a 0.4% gain, while U.S. crude futures advanced 22 cents or 0.3%. Amid the optimistic market mood, both benchmarks hit their highest level in 3 weeks on Tuesday. Now, the prices were also supported by news that Russia aims to ban oil sales from February the 1st to countries that abide by a G7 price cap imposed on December the 5th. Gold prices eased early on Wednesday, pressured by an uptick in the US dollar, having risen 2% in the previous session following China's decision to further ease COVID restrictions. Spot gold was down 0.2% to $1,809.58 per ounce, while US gold futures fell 0.3%. The price of gold in Egypt has risen to unprecedented highs, and according to experts, nervous savers are seeking refuge from a weakening currency, and some companies are exporting gold to raise scarce dollars to fund imports. Meanwhile, spot silver lost 0.4%, platinum slipped 0.5%, and palladium fell 0.5% as well. Now, the accumulated debts, we're looking at Nigeria now, from the unstructured supplementary service data, USSD, owed to telecom companies may lead to the withdrawal of USSD services. The president of the Association of Telecom Companies of Nigeria, ATCON, Mr. Ikechukwu Nnamani, who said the amount has hit 80 billion naira as of November this year, is asking for quick intervention by all stakeholders.
Of our knowledge, the banks have the money to pay for this service because it's been taken from the subscribers. So it's not a situation where the banks don't have the ability to pay. We see it more like unwillingness to pay rather than inability to pay. And that is why we are making this public, that hopefully, because we know the banks are in a position to make this payment, they will go ahead and make the payment so that the telecom industry is sustained and the infrastructure that they use to provide this service is able to be operated efficiently. The easiest way around it, in my opinion, is to set this up as an auto debit, auto credit system. In other words, we should not depend on the banks to make this payment whenever they feel like, or if at all they feel like. The moment this transaction takes place, the customer's account should be automatically debited and automatically credited to the relevant service provider's account. So having it as an auto debit and credit platform service should be the way to go. So that way, nobody is going to depend on any bank deciding or choosing whenever to remedy this payment.
High inflation and corresponding hike in interest rates to tame it by central banks in developed economies, especially in the US, have largely affected the cost of borrowing by emerging economies in sub-Saharan Africa. Patrick Huron, senior economist at Telecoms, joins us to review how these currencies have fared this year and what to expect going into the new year. Hi, Patrick. It's good to have you on the program.
Hi, well, good to be here.
Now, Patrick, if we cast a look back, how much of a blow have these currencies and most major economies in sub-Saharan Africa, how much of a blow have they taken this year?
The dollar is up about 7% year to date versus a basket of developed market currencies, whereas emerging market currencies, including those in sub-Saharan Africa, have actually held up a bit better and on average are down about 5% year to date. This is partly because emerging market central banks were more proactive in hiking their policy rates over the past 2 years. But aggressive rate hikes by the Fed over the past few months especially have started to erode that interest rate differential. And there's wide variation within the emerging market and sub-Saharan Africa currency universe. The Egyptian pound and Ghanaian cedi are both down about 36.5% year to date, so they're leading the way in terms of currency depreciation. And then the Kenyan shilling, South African rand, Ethiopian birr, Zambian kwacha are all down about 7 to 8%. Whereas more liquid currencies in East Africa, especially like the Rwandan franc, Ugandan shilling, are down just 3 to 4%, and the Tanzanian shilling and Mozambique metical are essentially flat so far this year. However, some of the stability in certain countries can be explained by currency management by the central bank, with sharp depreciations occurring instead in the parallel market. Nigeria is an example of this with a parallel market premium of about 60%. And likewise in Ethiopia, the exchange rate is trading at about a 90% premium on the parallel market.
So, looking at the downtrend you just talked about now, the flattish close for most of these currencies or currently trading at the moment, are we likely to see default in debt payments next year as a result of this?
Currency depreciation makes it more expensive to service FX-denominated debt, which is a large portion of the total public debt stock in many countries in sub-Saharan Africa. However, I think the bigger factor at play here is the tightening of global financial conditions, with the Fed's rate hikes pushing up the risk-free rate over the past year and spreads widening by quite a bit in many emerging markets. We count that yields are now above 10% and over a quarter of the emerging market index, which is typically a sign of distress in that market access has been lost. Countries without market access and with large external financing needs in the coming year will really struggle to avoid a debt and balance of payments crisis. We've already seen distress in Ghana, which announced plans to restructure its domestic and external debt this month. Other countries like Egypt and Kenya have managed to buy themselves some time by securing an IMF program and committing to difficult reforms, but risk will certainly remain elevated over the coming year. Countries at the greatest risk of default, we think, include El Salvador, Ethiopia, the Maldives, Pakistan, and Tunisia.
So is there recovery in sight for these economies, most of which you've mentioned, Nigeria? What policy changes would you recommend?
If the Fed reaches the end of its tightening cycle, as markets are currently expecting in 2023, then financial conditions could begin to ease for many distressed emerging markets, including those in sub-Saharan Africa, and the dollar could continue the weakening trend we've seen over the past couple months. However, there is still a risk that markets are pricing in an overly dovish rate path for the Fed over the next year, and that they'll have to adjust their expectations upwards, especially if inflation proves stickier than expected. In the meantime, countries on the verge of distress will need to make difficult policy decisions to avoid a crisis, including tightening their fiscal policy and recommitting to pro-growth structural reforms that have largely taken a backseat post-pandemic. Many countries may also need to adopt a more flexible exchange rate and allow currency depreciation to improve their balance of payments and ease FX shortages, including countries like Nigeria, Egypt, and Kenya, where the currency has been held at artificially strong levels.
So, Matt, so what you're proposing is that there has to be stringent policy changes by central banks. And would you think that resorting to an IMF loan is a solution right now for most of these economies?
It's certainly one part of the policy toolkit that many countries have and should continue to consider. Like I said, countries that don't have access to the market will need to rely on alternative financing sources to plug that gap over the coming year. That can include support from bilateral partners or other donor countries. And where that's not sufficient, a lot of the time that will require IMF support to plug that financing gap and help serve as a backstop for some of these politically difficult reform efforts.
Thanks so much, Patrick Curran, senior economist at Telecoms, for joining us and sharing your perspective on the program.
Thanks, Will.
Now moving on, Zimbabwe has recorded its highest wheat harvest this agricultural production year. The country harvested about 375,000 tons of cereal in 2022, a milestone in wheat production, according to Agricultural and Rural Development Advisory Services in the country. This bumper harvest is attributed to government support to local farmers through private and public sector participation. Zimbabwe emerges as one of the few African countries which has adopted import substitution agricultural policy and strategically working towards self-sufficiency amid the Russian-Ukraine crisis. Ghana and Thailand say they will work hand in hand to improve the quality of rice strains through technology and innovation. According to the Ghanaian government, the country mainly imports rice but lacks purchasing power due to the state of its economy. The West African nation says it will prepare around 200,000 rai of land and may even construct a research facility if necessary to enable Thailand conduct research into developing suitable technologies and rice strains for Ghana's local environment. Now, Ethiopia's flagship carrier, Ethiopian Airlines, has announced it will resume daily flights to Tigray's region capital, Mekelle. And this announcement follows the implementation of the African Union brokered peace deal after 2 years of halting flights to Tigray. In a statement, the national carrier said it would operate daily flights from Wednesday and increase the number of daily flights depending on demand. The airline says the resumption of flights would help families connect as well as facilitate business and tourism. The airline halted flights to the region weeks after the war broke out in November 2020 between Ethiopian Federal Forces and the Tigray People's Liberation Front. And that's it on Business Incorporated. Thanks for watching. I'm Willie Bong. Bye for now.